I suppose it's fair to say, in my sister's account, I have no career risk. She isn't going to fire me.
Ever since legendary investor Jeremy Grantham told WealthTrack how he kept his sister's money safe during the financial crisis, I have wondered, what about all the other women, many of them divorced, widowed, or lifelong singles who don't have Jeremy Grantham to call upon? Well, we've started a new feature on WealthTrack's website called WealthTrack Women. On a regular basis, investment pros who specialize in advising female clients will answer questions vital to the financial health of women. Look for it on wealthtrack.com. This week on WealthTrack, great value investor Joel Greenblatt has always searched for hidden treasures off the beaten path. But instead of seeking a few masterpieces, he is now looking for hundreds of companies to buy and sell. Gotham Fund's Joel Greenblatt explains his change of strategy next on Consuelo Mack WealthTrack.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fair Home Foundation. Hello and welcome to this edition of WealthTrack. I'm Consuelo Mack. It isn't often that a very successful hedge fund manager with a winning strategy closes up shop. That is what this week's guest did in 1995. Equally unusual is to get back in the business more than a decade later, but with a dramatically altered strategy. That is also what this week's guest did. I plan to ask him about both decisions. He is noted value investor Joel Greenblatt, the managing principal and co-chief investment officer of Gotham Asset Management, a firm he founded in 2009 with longtime business partner and investor Rob Goldstein. He co-manages the Gotham Funds, 4 long-short funds that go long hundreds of stocks, buying them believing they will appreciate in price, and shorting hundreds of others, meaning selling them betting they will decline in price. The largest fund, Gotham Absolute Return, was recently given coverage by Morningstar, debuting with a bronze analyst rating, Morningstar's 3rd highest ranking. The predecessor firm to Gotham Asset Management was Gotham Capital, also a long-short hedge fund firm he started with Goldstein in 1985. But it ran a heavily concentrated portfolio with as few as 6 to 8 holdings. They both decided to close it to outside investors in 1995 and give them their money back, even after delivering 34% annualized return since inception. Why did they do that? I will ask him. In the intervening years, Greenblatt started teaching a value and special situation investing course at Columbia Business School and helped start the Success Academy Charter Schools, which now operates over 30 schools primarily in New York City's poorer neighborhoods. Greenblatt has also written several books. You Can Be a Stock Market Genius, The Little Book That Beats the Market, The Little Book That Still Beats the Market, and The Big Secret for the Small Investor. I began the interview by asking Greenblatt to distill a lifetime of being a successful value investor. What is the secret?
If there's any secret, I think it's in understanding what you're doing. And most people don't think of stocks. They think of them as pieces of paper that bounce around and you put ratios on them or figure out difficult math problems with them. And to us, they're merely ownership shares of businesses that we're trying to value and buy at a discount. I think the people who are successful at it, A, understand that, and B, really enjoy what they're doing. I've been teaching for a long time, and I would say my most successful students are the ones who actually enjoy the process of figuring things out.
So what does value mean to Joel Greenblatt?
Value means exactly that, figuring out what a business is worth and only buying it when it's worth a lot less. Ben Graham said, figure out what something's worth, buy it at a big discount, leave a large margin of safety between those two, And that's still the key to it. It's not more complicated than that.
You and your partner, Rob Goldstein, have devised a ranking system using just two variables, is that correct? In return on invested capital and earnings yield?
Rob and I did a research project,
right.
And the very first thing we tested were those two concepts. Is it cheap? Does it earn a lot relative to the price we're paying? And is it in a good business? In other words, does it deploy its capital well? So cheap was Ben Graham.
Right.
His best student, Warren Buffett, made one little twist that made him one of the richest people in the world. He said, if I can buy a good business cheap, even better.
So not just cheap, but a good business cheap.
A good business cheap. And that was Warren Buffett's little twist that helped him be so successful over time. We started out a project to test the concept that I had been teaching my students, that Rob and I had been using for many years to make money, to see if we could prove those simple concepts worked very well. And the very first test we did of it ended up, I wrote a book about it called The Little Book That Beats the Market, because
right.
the tests were so phenomenally good. That's not exactly what we do now. In other words, that was done, I would call that the not trying very hard method. You know, we just use some crude metrics to simulate cheap and good, and those crude metrics work so well that we said, well, listen, we're roll-up-your-sleeve investors. We tear apart balance sheets, income statements, cash flow statements. That's what we do for a living. We've been analyzing companies for a long time. So can we take these concepts and really take them to the next level? The simple concepts work amazingly well. And so we sought out on a long project to improve on that, but the principles are still the same.
If I started, tearing up a balance sheet and an income statements, and if I were looking for, is my starting point return on invested capital and earnings yield? Is that would be my first kind of cut?
I think my first cut would be cheap.
Okay.
And that would be the earnings yield portion of what you're talking about.
Right.
I don't live in Manhattan, but if I did, and I had a 3-bedroom apartment, if it was available for $250,000, take my word for it, it would be a steal. At $50 million, it would be ridiculous. The quality of the apartment hasn't changed. It's the price that determines whether something's a good investment. So you can't invest without price.
And the second part, the return on invested capital, that's the good, whether it's good or not. And explain how you find return on invested capital.
Sure. Well, the example I gave in my book, The Little Book, which I really wrote for my kids to explain it, I gave 2 examples. I said, think about you're building a store. Well, you have to buy the land, you have to build the store, you have to set up the displays, you have to stock it with inventory, and let's say all that cost you $400,000. And every year that store spins out $200,000 in profits. That's a 50% return on tangible capital. Every business needs working capital. Every business needs fixed assets. How well does that business convert the working capital and fixed assets into earnings? Then I gave another example, and remember it's for my kids. And it's another store, and I called that store Just Broccoli. It's a store that just sells broccoli. Not a very good idea, but you still have to buy the land, build the store, set up the display, stock it with inventory. It's still going to cost you roughly $400,000. But because it's not a very good idea to just sell broccoli in your store, maybe it earns somehow $10,000 a year. That would be a 2.5% return on tangible capital. So I would simply say I would like to own the business that can reinvest its money at 50% returns than 2.5% returns. And if you read through Warren Buffett's letters, he doesn't use that term return on tangible capital, but that's what I called it in the book.
Talk to me about your strategy of choosing stocks, specifically for the diversified long-short hedge funds that you're running now.
Sure, it's probably disappointingly simple what I'm going to tell you, but basically we look at the 2,000 largest companies in the U.S. and we rank them from 1 to 2,000 based on their discount to our assessment of value. Stock number 1 gets the biggest weight in our portfolio. Stock number 2 gets the second biggest weight. Same on the short side. The most expensive stock relative to our assessment of value gets the biggest weight on the short side, and the second gets the second biggest weight. We own roughly a little over 300 stocks on the long side and 300 stocks on the short side.
So there's the 300 on each extreme.
Yes,
right.
They're not equally weighted, but we own over 300 on each side. And so what we have to do is be right on average, and we're pretty good on average. We're not always right, but we're pretty good on average.
And why couldn't I just duplicate that?
I wrote another book, it's called The Big Secret, and it's still a secret, I always say, because no one bought it. So I'll just tell you what the secret is.
Yes, please do.
The secret is really patience, is in very short supply. I give a few examples in that book. One of them is very telling. It looked at the top performing managers for the decade 2000 to 2010. It looked at the top quartile managers, the ones who ended up with the best record.
That's after the tech crash.
Yes, 2000
Right.
to 2010,
Right.
Inclusive of the tech.
Right, the lost decade, some people call them.
Right, the market
Right.
was actually flat during those periods.
Yes.
But the top quartile managers, here are their stats. 97% of those who ended up with the best record spent at least 3 of those 10 years in the bottom half of performance. Not surprising, but it's almost everyone.
In the same decade.
In the same decade. 79% of those who ended up with the best 10-year record spent at least 3 years in the bottom quartile of performance. And here's the stunning statistic. 47% of those who ended up with the best record spent at least 3 of the 10 years in the bottom decile of performance, meaning they were in the bottom 10%. So you're pretty sure that none of their clients actually stuck with them to get the good returns. And to beat the market, you have to do something a little different than the market. You're going to zig and zag a little differently. But clients are not very patient. I also wrote about a study of institutional investors, 2 actually academic studies, and both studies concluded the same thing. There is only one metric you need to predict institutional cash flows. And that metric is, how did the fund do last year? If it did well, it gets all the inflows. If it didn't do well, it gets all the outflows.
Where were you during that decade? Did you meet those statistics? Where, I don't know, however many years you were in the bottom decile or bottom 10%?
Sure, we didn't measure it, but yes, we had years. I would say our worst years were 1998 and 99 during the internet bubble.
Sure.
The market didn't agree with the way we were valuing companies. And then the market plummeted in 2000. It wasn't that we became geniuses all of a sudden. We were doing the same things we were doing in 1998 and 99 when it wasn't working. And we got paid off in 2000 when the market became more sane.
What are a couple of the cheapest companies right now that you're holding?
Well, there's one called Towers Watson, is a cheap company. It really does all kinds of work for companies, keeping track of their employees and everything else. And it's a very steady business. And now with healthcare reform, I think they're going to have continued growth going forward. So that's a nice business. VeriSign registers most of the domain names in the United States.
So that's another one that's, again, one of the cheapest by your evaluation.
Sure, it doesn't have a lot of growth. It's still growing about 5% a year, but it's a very steady income, big cash flow generation. So it's, good and cheap.
Right. And what's the turnover in your portfolios these days?
Well, the way it works is that, if we buy the company at the biggest discount to our assessment of value, here's value and here's price. Companies on a little, if I'm right in what I tell my students, companies on a little journey towards fair value over time. And as a company moves towards fair value over time, it's not as cheap as it used to be. It still could be very cheap, but not as cheap. So we'll sell some of it down and reinvest that cash in companies that are cheaper. So that's our process. But if you start at the beginning of the year in our long book, we probably have about 45% of the same names at the end of the year, but their allocation in the portfolio may change.
Right. And I'm going to ask you the flip side of that. So what are some of the most expensive names in that universe of 2,000 companies that you're looking at?
Well, Twitter's a company that has a lot of users, but not a lot of revenue and a lot of cash flow, and it's losing money, so that's not usually a good thing. Growth has slowed down, so be curious if they can turn that into a good business model. Zynga was a game company that loses lots of money and probably has seen its heyday, so that's another short that we have. And generally, we're looking for things that are earning very little or losing money and destroying capital as they do it.
What's wrong with the old-fashioned way of value investing, of just going long, of just buying companies that are really cheap and good?
Sure, there's nothing wrong with that, and for many years we pursued that.
Right.
I think perhaps part of your question would be, why do most people who go out, especially professional managers, to go out and beat the market fail? And I think they have very diversified portfolios of companies, and it's very hard to know, dozens or 30, 40, 50, 60 companies very well and know them better than other people. So I think the way to go about it, following that kind of strategy, would be much more, or at least one of the ways, would be in a much more concentrated strategy, keeping to what you know very, very well. And those companies are usually few and far between, so usually a handful of companies. And most managers don't stick to just a handful of companies. It's too volatile for their investors. They'll have to underperform a lot of times. So people don't really pursue that strategy. But if your goal is to beat the market, that's a good one.
And speaking of running a concentrated portfolio, Gotham Capital, the hedge fund that you co-managed with your longtime business partner from 1985 to 1995, it did have a very heavily concentrated portfolio. I mean, 6 to 8 names, I read somewhere. Why did you take that approach to begin with? Why be that concentrated?
Right, that's a great question, and it really goes to the answer I just said. We couldn't know companies very, very well.
Right.
If we had to know 50 of them. We might have to go through 50 or 100 companies to find those 6 or 8 that are at the biggest discount to our assessment of value. But what comes with such a concentrated portfolio is that every few years, 1 or 2 of your ideas, you wake up and they haven't worked out. You might lose 20 or 30% of your net worth in those few days. And if you have outside investors, they're not too pleased about that. If you're working with a partner like I have, Rob Goldstein, we understand what we own. We understand that it's just at a bigger discount if we haven't changed our opinion, and so we're willing to stick with it, but not many people would. The problem with, I think, giving money to idiosyncratic stock pickers is that I think investors don't know the logic that really went behind each investment. All they really have are the numbers, the results. Right. And unfortunately, returns over the last 1, 3, 5 years for managers don't have much to do with the next 1, 3, and 5 years. But that's all people look at, so that they're giving money to the people who have just performed the best, and they're taking money from the people who have performed the worst, but that's actually not what's going on. What you really want to look at is process. Are they evaluating and valuing businesses in a disciplined and effective way?
Is there some Greenblatt, golden rule or approach that enables you to invest in this, again, this very focused portfolio that got you those 34% annualized returns when you were running Gotham Capital?
Sure. Well, I actually wrote a book of war stories about things that I looked at. It was called You Can Be a Stock Market Genius, probably one of the most poorly worded titles ever. But in it, I tried to really explain
right.
How we go about doing things. So it was a compilation of war stories. I mean, one of the things I said in there was, if you don't lose money, most of the other alternatives are good. So that's one thing to think of. But mostly the book was about special situation investing. In other words, looking for things that are a little off the beaten path or a little complicated or just a little different than what other people are looking at. They're a company going through extraordinary changes. Something a little odd, something a little complicated,
right.
something a little different. So I would not say to get those type of returns, we had to be the world's greatest analysts. We just had to look under a few different rocks where other people weren't looking at the time. But it still all comes down to being able to value a business and buying it at a discount. It's just that why not turn the edge in your favor and look in places that other people aren't?
Do you have a special situation that you're investing in now that would exemplify your approach?
Well, frankly, what we're doing now in a very diversified approach is
right.
valuing businesses. And so about 6 years ago, Rob and I, my partner, we looked at each other and said, doing an intense amount of work on just a handful of companies is a full-time job. Covering a whole universe, a research universe of stocks, a few thousand stocks, even with a nice analyst team and a very talented analyst team, is also a full-time job. And we couldn't do both. And so we decided to go all in here. And part of it was that it was a little bit different than what we had been doing for several decades. The other part was there's a number of ways to make money. One is to be very concentrated in something you know well, and that's what we had done for a long time. And the other is to be right on average. The benefits of what we're doing now is that, as I told you before, when we owned a 6 or 8 stock portfolio and 1 or 2 of our investments weren't going our way, we might wake up and lose 20 or 30% of our net worth.
Right.
Today, with a more diversified portfolio, our bad days are 20 or 30 basis points of underperformance. And so for most investors, the reason we decided to take outside money in again is our other approach was probably not appropriate if, for most investors, really can't take the volatility of the type of approach, that concentrated approach. And the best strategy for most people is the one they can stick with.
Tell me why you and your business partner decided to close the heavily concentrated Gotham Capital fund and give the money back to investors, the outside investors.
Sure. We had a great record for 10 years.
Right.
We opened up in 1985, and at the end of 94, we had built up a great 10-year record, and we had done well enough to keep our staff and continue to run our money while returning outside money. Part of it is that we didn't want to Peter Principle our way out of what we knew how to do well. So in other words, as your assets rise, Warren Buffett said, the fat wallet is the enemy of high investment returns. And so as you raise more money, it becomes more and more difficult to get very high returns. And so,
especially in a very focused portfolio, or?
Yeah, especially in a very focused portfolio, at least that you have many more alternatives. As you run more and more money, and Buffett runs, probably $100 billion or so, you can't look at some of the smaller situations that you could before. And even if you could, you couldn't put a lot of your money, a big percentage of your money in those. And so I think it was just our way of keeping our hurdles pretty low. Being able to look at more choices is usually better. And so we wanted to, and it was a very concentrated portfolio. So it's a combination of those things. And we really enjoy what we do.
Explain the long-short strategy and why you think over the long term that's better than just being long.
Sure. Well, if you're able, when you're long and short, long, you're picking the cheapest companies you can find, the ones that are at a discount, the ones that you think will give you good returns over time.
You are as a value investor.
Yes.
Right.
And as on the short side, you're trying to pick expensive companies that are actually going to come down over time, meaning they're overpriced, and the market will realize that they're overpriced and come down over time. If you're good at doing both, you have 2 ways to make money, one on the stocks you like the best and one on the stocks you like the least. So what we're trying to construct is something that makes it easy to be a contrarian value investor, buy things people don't want, short things that people love to death at the moment, and that's potentially a volatile market, but we're trying to make it as diversified and easy to take as possible. So it's always tough to be a contrarian, and we're trying to make it as painless as possible. It's not always successful, but that's the goal.
How do you justify, I guess from a value investor perspective, the fact that you are investing in so many companies? They all can't be the best. Doesn't that bother you at all? I mean, you're dealing now with numbers as opposed to individual companies that you know inside and out.
Sure. No, it's a great question. So the big picture is we're excellent on average. We're not right every time. We're right most of the time, however, and that's all we need to be when we have 300 names. On average, we get it right. And some things are inherently uncertain. A lot has to do with what's going to happen in the future. It's been shown that Wall Street analysts aren't particularly good at doing that. But when we're using our metrics of valuation, both cheap and good, on average they work quite well over time.
Last question, the one investment for a long-term diversified portfolio, I asked each of our guests what that should be. Obviously, none of our guests can recommend their own funds. So what would you have us all own some of in a long-term diversified portfolio?
Well, number one, for tax reasons, ETFs are a great structure, meaning you don't pay taxes till you sell them. So if you bought an ETF, a share in an ETF today, and held it for 20 years, when you get dividends, you'll pay taxes on that, but you won't pay any taxes. It's almost like a retirement account. You don't pay taxes if they're well structured till the 20 years where you sell them. I wrote a whole book saying that market cap weighted indexes aren't really the smartest way to go about investing.
Because?
Because for market cap weighting, what that means is you buy more of the bigger companies, the ones with the higher prices. And if a company is overvalued, what you tend to do is buy more of it because you're buying the ones at the highest prices.
Right.
And if a company is bargain priced, you're owning less of it. So it's really a systematic way to do the wrong thing at every stage. And that costs you about 2% a year. So your alternatives would either go to an equally weighted index, could be an equally weighted S&P 500, and those work, and then you just make plenty of errors, but you make them randomly, so you get the 2% back that you make the mistakes with a market cap weighted index. You can buy a fundamentally weighted index, or what I would prefer probably is a well-constructed value index, but in the form of an ETF, so that you have the tax advantages. And for most people, most funds don't beat the market over time. So the advice to buy an index, despite what I do for a living, is quite good. It's just you should buy the right index.
Joel Greenblatt, thank you so much for joining us from the Gotham Funds. It's been like taking your class at Columbia Business School. We really appreciate it.
Thanks so much for having me. Really appreciate it.
At the close of every Wealth Track, we try to give you one suggestion to help you build and protect your wealth over the long term. This week's action point is read Joel Greenblatt's The Little Book That Still Beats the Market. It's the revised edition of his original bestseller, which the Wall Street Journal called one of the best, clearest guides to value investing out there. Greenblatt's intent in writing the book was to provide advice that, while sophisticated, could be understood and followed by his 5 children, ages 6 to 15. According to the Journal Review, they are in luck. The Little Books are a terrific investment series and make great presents all year round for individual investors. For more of our interview with Joel Greenblatt, please go to our website's extra section, and don't forget to visit our Wealth Track Women's section for personal finance advice, particularly for women. Have a great weekend and make the week ahead a profitable and a productive one.
New York Life, along with Mainstay's family of mutual funds, offers investment and retirement solutions so you can help your clients keep good going.
Additional funding provided by Loomis Sales, investors seeking exceptional opportunities globally. Wintergreen, your home for global value. Rosalind P. Walter and the Fair Home Foundation.